At 5:47 a.m., a single light turns on in a glass tower while the rest of the city is still asleep. In a cramped apartment across town, an alarm explodes in the dark. A man reaches out, silences it, and stares at the ceiling already tired. On the other side of the world, numbers flicker across a silent screen. Red, green, red again. Someone watches them without emotion. 3 rooms, 3 lives, the same sunrise, but only one of them understands what the morning is really worth. The difference is not intelligence. It is not luck. It is not even money. It is the way they think. Most people wake up and immediately enter the race. They trade hours for currency. They measure their worth by effort. They believe income is something earned only by sweat. The 1% wakes up and asks a different question. How can this hour work for me, even when I am not here? That question changes everything. You can feel it in the air of financial districts. The quiet hum of elevators rising through towers of steel and glass. Behind tinted windows, people stare at charts not as gamblers but as architects. They are not chasing money. They are positioning capital. The world has taught billions to work for income. But it has taught almost no one to build systems that produce it. And that is where the divide begins. In school, children are rewarded for correct answers. For obedience. For following instructions precisely. They are rarely rewarded for questioning the structure itself. So they grow up mastering compliance. They learn to trade certainty for security. Time for salary. Effort for approval. It feels safe. It feels responsible. It feels normal. But investors do something dangerous. They detach identity from labor. They see money not as a reward for effort, but as a tool that can multiply itself. This sounds simple. It is not. Psychologists call it delayed gratification. The ability to resist immediate pleasure for long-term gain. The famous marshmallow experiment showed that children who could wait tended to achieve more later in life. But investors take this concept further. They delay not just pleasure. They delay ego. While others buy status symbols to prove progress, they buy assets that quietly compound in the background. The car can wait. The applause can wait. The vacation can wait. Because they are watching something invisible grow. Compounding is almost mystical. A snowball rolling down a mountain, collecting more snow, accelerating with every meter. Money earning money. Then that money earning more money. Most people interrupt this snowball constantly. They earn. They spend. They reset to zero. The 1% protects the snowball at all costs. They understand that the first dollars are the hardest, the slowest, the most fragile, and they treat them like seeds in a drought. There is a strange calm in their decisions. When markets fall, panic spreads like wildfire. News anchors raise their voices. Social media trembles with fear. Ordinary investors sell to stop the bleeding. The 1% leans back. They know something others do not. Volatility is not danger. It is opportunity wearing a frightening mask. Behavioral economists have shown that humans feel losses more intensely than gains. Loss aversion. The pain of losing $100 feels stronger than the joy of gaining 100. This bias drives millions to sell low and buy high. The 1% trains themselves to reverse the instinct. When fear peaks, they search for value. When euphoria explodes, they step away. This feels unnatural. Because it is. Our brains evolved for survival on savannas, not for navigating digital markets. We are wired to follow the herd. If everyone runs, we run. In ancient times, that saved lives. In financial markets, it destroys wealth. Investors in the top 1% understand herd behavior deeply. They watch sentiment like meteorologists watch storms. They track narratives spreading across media. They sense when optimism becomes mania. They are not smarter in IQ tests. They are calmer under uncertainty. And calm is rare. Consider how society frames money. For most, money is survival. Rent, food, bills, debt. The constant pressure creates tunnel vision. When cognitive load increases, decision quality decreases. Studies show that scarcity consumes mental bandwidth. It narrows focus to immediate problems. If you are drowning, you do not analyze ocean currents. You gasp for air. The 1% escapes this mental trap early or builds systems to avoid it. They automate savings. They create buffers. They design financial runways long enough to think strategically. Space creates clarity. Clarity creates better decisions. And better decisions compound. There is another difference, quieter but more profound. Identity. Ask someone what they do, and they answer with a job title. Teacher, engineer, driver, designer. Ask an investor in the 1%, and the answer is often different. They might say they allocate capital. They might say they build portfolios. They rarely define themselves by tasks. They define themselves by ownership. Ownership is psychological power. When you own equity in a company, even a small fraction, your relationship with the economy shifts. You are not just a consumer. You are a participant in growth. You benefit when productivity rises. When innovation succeeds. When scale expands. Most people stand outside the machine, selling labor to it. The 1% buys pieces of the machine. This shift sounds abstract, but it changes behavior at a cellular level. When you see yourself as an owner, you start thinking about long-term durability. You analyze business models. You study incentives. You care about margins and moats. You stop asking, how much will I make this month? You start asking, how resilient is this system over 10 years? Time horizon becomes a weapon. In fast-moving cultures obsessed with instant results, patience becomes rare. Rare things are valuable. The 1% stretches their time horizon beyond quarterly noise. They think in decades. Some think in generations. This perspective allows them to endure temporary discomfort without abandoning strategy. There is a moment, often unseen, when a future investor stands at a crossroads. It might happen in their 20s. They receive their first significant income. The temptation is immediate. Upgrade lifestyle. Increase consumption. Match peers. Instead, they choose asymmetry. They live below means. They invest the difference. Friends may laugh. Family may question. But they are planting forests while others are decorating apartments. Over time, the forest begins to breathe on its own. Dividends. Appreciation. Business equity. Real estate cash flow. Digital assets. Intellectual property. Each tree small at first. Then interconnected. Then unstoppable. Technology has amplified this divide. Never before has information been so accessible. Financial data streams in real time. Research papers are free. Markets are global and open through a smartphone. Yet access alone does not create investors. It creates noise. Algorithms compete for attention. News cycles accelerate. Opinions multiply. The signal is buried. The 1% filters relentlessly. They understand that attention is capital. Where attention goes, money often follows. They do not scroll endlessly through fear-inducing headlines. They study primary sources. They read annual reports. They examine cash flows. They analyze incentives behind every narrative. They treat information as an asset class. This discipline feels boring, and that is precisely why it works. In a culture addicted to excitement, boredom is undervalued. Investing done correctly is often dull. It requires repetition, consistency, small actions performed over years. But humans crave drama, so many chase speculative spikes, quick trades, viral trends. They experience adrenaline instead of accumulation. The 1% avoids addiction to volatility. They focus on expected value. Expected value is a simple but powerful concept from probability theory. It measures the average outcome of repeated decisions. Most people judge decisions by outcomes. If a risky bet pays off, they call it smart. If a rational investment temporarily drops, they call it stupid. The 1% judges decisions by process. Was the risk understood? Was the reward asymmetric? Was the downside survivable? If yes, the temporary outcome does not disturb them. They think in distributions, not single events. This mindset protects them from emotional whiplash. There is another layer, even deeper. They understand leverage. Not just financial leverage through debt, but operational leverage, network leverage, technological leverage. A single line of code can serve millions. A piece of intellectual property can generate royalties for decades. An investment fund can allocate billions with a small team. They search for systems where input is limited but output scales. Most people exchange 1 unit of effort for 1 unit of income. The 1% searches for exponential curves. They look for inflection points. They are obsessed with optionality. Optionality means having the right, but not the obligation, to act. Investors structure their lives to preserve options. Cash reserves, diverse networks, knowledge across fields. When opportunity appears, they can move. Others hesitate because commitments trap them. High fixed expenses, no liquidity, no margin for error. Margin of safety is sacred to the 1%. The phrase originated in value investing. Buy assets significantly below intrinsic value to protect against mistakes. But they apply it to life. They avoid overleveraging. They avoid lifestyle inflation. They avoid decisions that remove flexibility. This restraint appears conservative, yet it enables bold action when probabilities align. There is a paradox here. To outsiders, the wealthy often seem risk-seeking. In reality, they are risk-managing. They take calculated risks with defined downside. The masses take uncalculated risks daily. Relying on a single employer. Carrying high-interest debt. Ignoring diversification. These are silent risks. They feel normal because everyone does them. But normal does not equal safe. Sociologists note that social norms strongly influence behavior. If your environment prioritizes consumption over investment, you internalize it. If your peers celebrate spending but rarely discuss ownership, your aspirations narrow. The 1% often curates environment intentionally. They surround themselves with thinkers who discuss capital allocation at dinner tables. They normalize investing conversations early. Language shapes perception. If you grow up hearing words like equity, yield, compound growth, you begin to see the world differently. If you grow up hearing only bills and paychecks, your framework shrinks. This is not destiny. It is conditioning. And conditioning can be rewritten. But rewriting requires awareness. There is a moment when someone realizes they have been running on a treadmill. Working harder each year, yet feeling no closer to freedom. That realization can spark transformation. But transformation is uncomfortable, because it demands a shift from certainty to ambiguity. Employment offers predictability, a salary deposited on schedule. Investing offers uncertainty. Returns fluctuate. Markets swing. The 1% builds tolerance for ambiguity. They understand that volatility is the price of admission for growth. They also understand that knowledge reduces fear. They study history, market crashes, bubbles, technological revolutions. They see patterns repeating across centuries. Railroads, electricity, automobiles, the internet. Each wave created panic and opportunity. Those who understood underlying shifts accumulated disproportionate wealth. Those who reacted emotionally missed inflection points. Today, new waves form silently. Artificial intelligence, renewable energy, biotechnology, decentralized finance. The 1% does not chase headlines blindly. They evaluate adoption curves, regulatory landscapes, competitive advantages. They ask, who captures value? Not who is loudest. This analytical lens is rare because it requires effort without immediate reward. Reading financial statements does not produce instant dopamine. Posting about luxury purchases does. Our brains reward visibility. Investing rewards invisibility. You cannot see compound interest working in real time. It grows quietly, like roots beneath soil. This invisibility discourages many. They abandon discipline because progress feels slow. The 1% understands exponential curves. In early years, growth appears flat. Then suddenly, it bends upward. They remain patient during the flat phase. This patience is psychological resilience. Resilience is built through exposure to small stressors. Investors intentionally take manageable risks early. They learn from losses. They detach shame from mistakes. Most people avoid financial risk entirely or take extreme risk impulsively. The 1% calibrates. They test. They iterate. They refine mental models. Mental models are simplified representations of how the world works. Investors collect models from economics, psychology, physics, and biology. They think about feedback loops, incentive structures, second-order effects. If this happens, what happens next? And after that, they resist linear thinking in a nonlinear world. When governments print money excessively, they consider inflation expectations, currency devaluation, asset repricing. When technology reduces transaction costs, they anticipate disruption in legacy industries. They connect dots across domains. This interdisciplinary thinking is uncommon because specialization dominates modern education. Yet wealth often accumulates at intersections. The 1% stands at crossroads between fields. They notice inefficiencies others overlook. Another subtle trait emerges. They separate signal from identity. If an investment thesis fails, they do not collapse emotionally. They update beliefs. They view opinions as hypotheses, not personal truths. This intellectual humility protects capital. Ego is expensive. Many lose fortunes defending positions simply to avoid admitting error. The 1% cuts losses when data changes. They reallocate. They move forward. There is an image that captures this mindset. A chessboard in a silent room. Most people move pieces reacting to the last move. The 1% thinks several moves ahead. Not because they predict perfectly, but because they simulate scenarios constantly. They accept uncertainty as permanent. Instead of fighting it, they design around it. This design principle extends to relationships. They value networks strategically, not transactional networking for quick gains, but long-term trust-based connections. Capital flows through trust. Opportunities circulate among those perceived as reliable and competent. Reputation compounds like money. One successful partnership leads to another. Doors open quietly. While others submit resumes, they receive invitations. This is not magic. It is accumulated credibility. And credibility requires consistency. Consistency requires discipline. Discipline requires vision. Vision requires stepping outside immediate gratification. The cycle reinforces itself. Meanwhile, the majority remains trapped in short-term loops. Paycheck arrives. Expenses expand. Savings shrink. Stress increases. Stress reduces cognitive flexibility. Poor decisions follow. The loop tightens. Breaking this loop demands a mindset shift from consumer to allocator. From spender to owner. From reactive to strategic. It is not about earning more alone. High income without investment discipline often leads to higher expenses. Many celebrities and athletes earned millions yet faced bankruptcy. Income is fuel. Allocation determines direction. The 1% treats every dollar as an employee. Each dollar must justify its existence. Will it generate return? Will it reduce risk? Will it create options? If not, it is reconsidered. This level of scrutiny feels exhausting to some. To investors, it feels empowering. Because it creates control. Control over time. Control over exposure. Control over trajectory. Perhaps the deepest difference lies in how they perceive freedom. Most equate freedom with consumption. Luxury. Leisure. Visible abundance. The 1% equates freedom with autonomy. The ability to choose projects. The ability to say no. The ability to walk away from toxic environments. Autonomy requires assets generating income independent of labor. That is why ownership matters so profoundly. When passive income covers living expenses, psychological state transforms. Work becomes optional, not obligatory. Creativity increases. Risk tolerance expands. Ironically, this often leads to even greater wealth. Because decisions are no longer driven by desperation. They are driven by strategy. There is a silence that surrounds true investors. You rarely see them boasting. You rarely see them panicking. They operate beneath headlines. While society debates political drama and viral trends, they analyze balance sheets. While many argue online, they read quietly. While others compare lifestyles, they compare cash flows. This contrast is stark, yet invisible. That invisibility protects them. If everyone thought like investors, markets would behave differently. Opportunities would compress. Edges would vanish. The 1% benefits from majority behavior. From impatience. From fear. From herd instincts. This is uncomfortable to admit. But markets are ecosystems. For some to outperform, others must underperform. This is not cruelty. It is structure. Understanding structure is the final revelation. Wealth concentration is not solely about greed or injustice. It is also about cognitive frameworks. Those who think in systems accumulate system rewards. Those who think transactionally receive transactional outcomes. The gap widens over time. Not because of a single decision, but because of thousands of small ones aligned consistently. Morning after morning, year after year, remember the 3 rooms at sunrise. The alarm clock, the glowing screens, the quiet tower. As the city awakens again, most will rush into another cycle. A few will step back. They will review portfolios, rebalance allocations, study new data, plant more seeds. It will not look dramatic. No fireworks, no applause, just disciplined thought repeated relentlessly. And, decades later, when observers wonder how such vast wealth accumulated seemingly out of nowhere, the answer will not be a secret formula. It will be a mindset. A quiet, patient, system-oriented way of seeing the world. 1% thinking, invisible at first, inevitable in the end.